Video, we'll be going over IRS Form 2159, Payroll Deduction Agreement. This form is usually completed by a taxpayer who has agreed, at least in principle, with the Internal Revenue Service on establishing an installment agreement and is looking to have their tax payments directly deposited from their paychecks. According to the Internal Revenue Manual, this is a highly recommended way of agreeing to an installment agreement specifically for wage employees who are paid on a regularly scheduled basis, not necessarily for seasonal or self-employed individuals, seasonal employees or self-employed individuals. However, you may be eligible for a reduced user fee or an eliminated user fee if you use a payroll deduction agreement, and this is the only other option. You may also be able to establish a direct debit installment agreement, but that is beyond the scope of this article, and this form would be a backstop for taxpayers who are not able to make debit payments. So there are 6 pages to this tax form. The first page is the acknowledgement copy of the form that is returned to the IRS. There's a version of this that's for the employer to acknowledge and authorize. A payroll deduction agreement is subject to an employer's authorization. And then finally, the last version is the taxpayer's copy. So behind the employer's version and the taxpayer's version are specific instructions to each individual or entity. So we're going to go to the top of the form, and we're simply going to go over how to complete this form. So you would enter into the employer's field whatever the employer's name is. We'll just assume that we're using Acme Grocery Store. 1, 2, 3. And then you would enter whatever the taxpayer's name is. And then if there's a separate point of contact, then you would enter that person's name in there. So this is for the employer if the IRS has deemed the tax debt to be satisfied early, then this gives the IRS a point of contact at the employer to reach out to so they can stop the payroll deduction. So then on the right, we'll enter the Social Security number for the taxpayer. If the taxpayer has an employer identification number instead of a Social Security number, then you may enter that as well. And then if the taxpayer is married, you would enter the last 4 digits of their spouse's Social Security number. So in the employer field, there are instructions on the back of Part 2, and they specify certain things that the employer should do, right? Establishing the contact person in the case that the IRS needs to reach out and change the installment agreement or terminate it because the employee's tax liability has already been satisfied. And then the employer should complete this block that says how often the employee is paid and the date by which the employer will send money that they have deducted from the employee's check. So this is an additional administrative task that an employer has to take on, where they actually have to physically withhold earnings and then send a check to the IRS made payable to the United States Treasury. So specifically, the instructions on the back of the form state that an employer should write their employee's name and social security number on each payment and then send the money to the IRS mailing address that's on the letter that accompanied the agreement. Normally, this agreement would be sent to a taxpayer as part of an ongoing discussion, or as part of the collections process. So even though this might not be pleasant to a taxpayer, further escalations of the tax collection effort are much more uncomfortable. So from the employer's perspective, we'll complete this section. So we'll just assume that employee forced bomb over is paid every 2 weeks, and then the date that payments will be sent we'll say we'll send payments on the first of the month, beginning on so this is pretty much what you would complete as the employer. As the taxpayer would fill out the right-hand side, checking as to whether or not they are unable to make debit payments. And then right below that is information about the kinds of taxes that the taxpayer is responsible for. So if you go to the instructions for the taxpayer, then basically it spells out all the things that should be completed. If you're receiving this form from the IRS, the odds are likely that the IRS employee probably filled a lot of information in, to include the amount of money being deducted and the periodicity. So, and probably the collections information for up here. So we'll assume that they did not do that, and that the taxes being collected are from previously filed IRS Form 1040s, individual tax returns. We'll assume that this is from tax years 2019 to 2021. As of, we'll complete a mystery date. We'll just say May 1st, 2023. The taxpayer owed $50,000, and then applicable penalties and interest. And then the taxpayer is also attesting that they're being paid on the same schedule that the employer states that they're being paid. So this probably will be filled in already. So as the taxpayer, I agree to have, let's call it a rule of thumb, that this type of agreement should be paid off over 72 months. So let's just say that the taxpayer committed to paying $800 every 2 weeks, beginning on and paid by the employer to the IRS until the total tax bill is paid in full. And then for an existing agreement, then the IRS revenue officer may have inserted either a date of increase, which is most likely, let's bump up those payments and get this tax bill paid off. Probably not a decrease unless there's a significant reduction in the balance. Like if you paid a significant chunk of money and greatly reduced your tax balance as part of refinancing your house. You got some extra money, you decided to pay this down, but now in exchange for doing that, you need to reduce your monthly payments so that you can then have those monthly, the additional money going over to the mortgage side of the ledger. So you could say that I'm requesting a decrease in 2023 in July. We'll say minus $200. So the new installment agreement amount would be $600. So now, if there are additional terms, this would be input by the IRS revenue officer, and then you and your spouse, taxpayers, would sign right here on the form. If there's a title, then you would you would enter the title plus the date. So this is the copy of the form that goes to the IRS, which is identical to the taxpayer's version of the form. And then finally the employer's version. All three of those are the same. Couple of key notes to go over while we're reviewing this document. So this is under the terms of agreement in the fine print that you might not want to read, but we'll kind of summarize everything. So basically it's stating that if that the taxpayer is going to make each payment so that the IRS receives it by the due date on the front of the form. So if the taxpayer cannot make the payment or there's an additional tax bill that they accrue, then you need to contact the IRS. The agreement is based on your current financial condition. The IRS can modify or terminate the agreement if your ability to pay has significantly changed, and you may need to provide updated financial information. So, for example, if the IRS catches wind that you're earning a lot more money and you can pay this down sooner rather than later, they'll probably reach out to you. Like, for example, if you're in the middle of an agreement and you've consistently filed your tax returns and your adjusted gross income has always been $100,000, and your most recent tax return filed and processed shows that your AGI is now $200,000, you can probably expect some correspondence from the IRS asking you to step up your payments. And you'll probably receive a copy of Form 2159 that's been pre-filled by the revenue officer. And the IRS does reserve the right to terminate your current installment agreement if you don't make your installment payments, if you're not paying down your tax debts when due, or if the IRS reaches out to ask you for updated financial information and you turn around and don't give it to them, then they can terminate this installment agreement and you're back in the situation that you were in without an installment agreement. As long as an installment agreement is in place, the IRS cannot take further collection action against you. But once that installment agreement is terminated, then the clock starts running and you may be subject to an escalation of collection actions. So some of the other terms of agreement, any tax refunds that you would normally receive or any overpayments of your tax bill, they're going to be applied to an outstanding balance until you've paid your balance all the way down. So if you owe $50,000 and then you're expecting a $5,000 refund, don't expect that refund. Instead, you should expect your balance to go down to $45,000. Then there is a user fee that most taxpayers may have to pay. It's generally $225. You may be eligible for a reduced user fee of $43 that may be waived or reimbursed. This is a reduced fee for low-income taxpayers. So if you think you meet the criteria to qualify under the IRS low-income taxpayer guideline, which is at or below 250% of the poverty guidelines, which are updated annually by the Department of Health and Human Services. If you believe that your income is at or below that threshold, then you should look at IRS Form 13844 for more information about how you could qualify for that. If you default on your installment agreement and the IRS terminates it as a result, then you have to pay an $89 reinstatement fee. Again, for low-income taxpayers, you may be eligible for a reduced fee of $43 that may be waived or reimbursed if you meet certain conditions. And the IRS reserves the authority to deduct this fee from your first payment, so they're going to get this money. Generally, the IRS applies payments in order of oldest debt going forward. Specifically, if you have tax debt that is, say, 5 years old, and then you have tax debt from 2 years ago, you're going to be paying down your old balance first. If the IRS terminates your agreement, then as I previously mentioned, they can start going back to collection efforts. This might include levying your income, bank accounts, other assets, seizing property. You should receive a notice from the IRS prior to terminating your agreement. So you should not expect to be completely blindsided. If for some reason your agreement is terminated without notice, then you should call the taxpayer advocate to see what happened. There may be either an explanation, or you might have caught the IRS doing something out of order, and the taxpayer advocate can hold the revenue officer accountable. Let's say if the IRS feels that their ability to keep collecting this tax is in jeopardy, they can terminate this agreement. This agreement may need to be approved within the management levels of the IRS. You can see that there is an IRS use box down below here. So this is kind of internal language about when the statute, for example, the CSED, the statutory, the collection statutory expiration date, which is the date after which the IRS can no longer collect on a certain debt. So there's going to be a review to make sure that this is the appropriate way forward, and specifically whether or not the IRS needs to file a notice of a federal tax lien. So if you owe money above a certain threshold, the IRS is required to place a federal tax lien on something that they can seize, even if you've entered into a negotiated agreement. So, and that's described in depth in the Internal Revenue Manual. And then also, finally, by signing and submitting this form, you're authorizing the IRS to contact third parties and to share your tax information in order to process and administer this agreement. So banks, your employer, things like that. So like I said, instructions to each individual or the business owner are on the back of each party's copy of the form. So we just saw the instructions to the taxpayer, which is on the back of Part 3, the taxpayer's copy. There are instructions for the employer on the back of Part 2, which is the employer's copy. And that brings us to the conclusion of this video. If you'd like to learn more about your payroll deduction agreement and how to set one up, check out the article that we've written, you can go to our website, teachmepersonalfinance.com, type in IRS Form 2159 in the search bar, and our article should appear. If you like our articles, please subscribe to our newsletter, which you can opt into from any article on the website. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions, comments, or concerns, please don't hesitate to reach out either by posting a comment in the comments section or by sending me an email. Thank you very much.